module quiz.
No, sir, I have not done it yet. I have not completed it yet.
Module quiz you have not completed yet.
Questions are this lengthy, so it took time. So I have not done it yet. I'll complete it.
Okay.
I've done only two, three questions. I did not get any uh, doubt in those questions. Those were easy ones.
Okay. Now we are supposed to begin from reading 20, right?
Wait.
Reading 20.
Yeah,
Okay.
market-based valuations.
Yeah. Mm. Okay, this is an easy one only. Market based. These are all P multiples.
Okay.
Okay. Enterprise value, momentum indicators. Compare your stock's price or your company's earnings to their values in their earlier periods. Okay. You can just quickly read this theory. See, you should also read theory in equities. These are very interesting one and very
Yeah,
easy one also.
yeah,
It's not even difficult as well.
yeah. I've started doing it. It's not that, yeah, it's not that difficult.
These all are very easy. Just go through this. See if you want me to explain anything here.
Sir, if you're sharing the screen, I'm not able to see the screen.
See, if I'm not sharing, you just tell me immediately, because
Uh,
if I don't share, then what will I do? Why am I then using the screen then?
because sir, like okay, I had opened my book, so I thought you were when you said all these and all, so I thought that you were sharing screen.
No, whenever if you are not able to see the screen, you immediately tell me, because
Okay,
there is no purpose only now of using this if I'm not sharing this. Either I have to share or you have to share something.
okay,
Otherwise, why are we using this method?
okay. Sorry, sir.
Huh. You
Yeah.
just go through this. It's a very easy one. Just tell me you need explanation.
Yes, sir.
MK Technology shares are selling for 20. Earnings for the last 12 months were 2. So this is earning per share.
It's
The
basic
trailing
P
P
ratio,
ratio
no?
is 32. Huh.
Yeah.
So determine whether MK is overvalued. So how to find out MK is overvalued or undervalued? Using P multiple.
Hmm.
So using P multiple, uh, so selling for 50. Okay, see the price. See, this is a very simple as well as very important formula. Price is equal to P into EPS. Okay, P
Hmm.
into EPS. So P ratio is what? 2032. And EPS is what? EPS is 12.
Hmm.
Okay. Uh, P ratio for the firm is 32. EPS is 2. Earning for the last 12 months were 2. So that becomes
64.
what? 64. And it is trading at 50. So because it is trading at 50 and its price should be 54.
Hmm.
Okay, so it is relatively undervalued.
Okay.
Okay, you can calculate like this, or they have mentioned PE perspective. They now I'm creating price as the base, and then I'm
Hmm.
saying, like, it is undervalued.
Hmm.
Okay, here it is 50 and here it is 64.
Hmm.
I can even make PE as the base. So right now, what is the PE? Price to earning. Price is 50. 50, earning is 2
2.
rupees. So it is 25.
25.
So which is what? Lower than 32, which
Hmm.
is the normal PE.
Hmm.
The average trading P is 32. So it
Hmm.
is undervalued. Whichever
Okay.
way you want to calculate, you may calculate.
Yeah. Wait a minute, sir. I'll write this thing.
Huh. This is a very simple way and very effective also.
Done, sir. Hello.
Yeah. Done. Okay. The next one, method of forecasted fundamentals. Okay. Just go through this.
Yeah.
Forecasted fundamentals. It says shares of Comtronics Inc. are selling for 30. The mean analyst earning per share forecast for next year is 4. Okay, so this is the EPS, expected EPS is 4. Long run growth rate is 5%. Comtronics have a dividend payout ratio of 6%. And the required return is 14%. Calculate the fundamental value of Comtronics using the Gordon growth model and determine whether Comtronics shares are over or undervalued using the method of forecasted fundamentals. Whether these are undervalued or overvalued using the method of forecasted fundamentals. So forecasted, okay. Uh, hmm. Forecasted fundamentals. So here earning per share. So based on leading, forecasted means leading P ratio. Leading P ratio, how can you find out? P0 is D1 by R minus G. So both the sides E1. Okay. So now that is equal to dividend payout ratio.
By R minus G, which is equal to 1 minus B upon R.
1 minus retention ratio. Now we will see what is the given information. Selling for 30, the mean analyst expects EPS to be 4. So EPS is this part, 4. And the long run growth rate is 5%.
14% is required return.
One minute. Huh? Huh.
14% is required.
Dividend payout ratio is 60%. So I can use this one. 60% dividend. No, 1 second. Dividend payout is 60%. So 60% of these earnings they gave, right?
Yeah.
The long run, where is earning is 4. So 60% of 4 is what?
2.4.
2.4. So I can use this one, 2.4. And
14. Required rate of return.
return 14. So calculate now.
Yeah. 6.66.
So P ratio right now it should be 6.66.
Yeah.
Okay. So what is the question then? Gordon growth model, whether it is undervalued or overvalued. Calculate the fundamental value of Comtronics using the Gordon growth model and determine whether Comtronics shares are over or undervalued using the method of forecasted fundamentals. Okay, so this is what it should be. But right now, let's see what is the P ratio. So right now it is trading at 30. And earning per share is expected
4.
earning. So directly P0 by 1.
7.5.
30 divided by expected earning E1 is
4.
4. How much is this? 7 point.
7.5.
So this 7.5 is greater than 6.6. That
So it's
means
overvalued.
it is overvalued.
So through that earning thing,
Hmm.
through earning we can find out what should be the price also, no?
Through earning, we can find out what should be the price. So P0 is equal to P divided by E, right? So
Yeah.
P should be, okay,
7.
6.6.
Huh.
Should be 6.6.
Huh.
Earning per share was 4.
Yeah.
So multiply this.
26.64.
So it should be 26.64. But right now it is trading at 30. So that's
Okay.
why it is overvalued. Already it is trading at 30. So it is overvalued.
And through Gordon growth that they have done, they also got 26.67.
Yeah.
So how did they get the same answer? Through Gordon growth also they got
We have done
26.67.
26 point. Uh, 26. Where is 26? This one.
Yeah.
Ah, so this is Gordon growth only I have applied, right? See, that's why I deliberately did not. I always, don't write this completely. This P ratio is based on Gordon
Mm-hmm.
growth only.
Yeah, but we found out PE ratio. But they did not do PE ratio. They found out price through Gordon growth, and both the price are same.
No, no, no. See, this is Gordon growth model,
Yeah,
and then I apply E1
yeah,
and then E1 here. Now
yeah,
E1 is what? For 1 rupee, no?
yeah.
So that 1 rupee, so this automatically becomes to earn 1 rupee what the market is willing to pay. That becomes value.
Okay, got
Okay. So now if you want that number exactly, this is for 1 rupee this much.
it.
So for 4 rupee, what
Four
is it?
rupees, how much? Yeah,
So that will come to the same number.
yeah,
26 something you mentioned, no? This one,
yeah.
26.67 it will come to then. This is to earn 1 rupee. So to earn 1 rupee, it is 6.6. To earn 4 rupees, they are currently earning 4. Hmm. Hmm. What time do you prefer? 10:30 or something like earlier than this 8:30, 8 o'clock? What is your preferable time?
No, anything is fine.
Fine. No?
Yeah, anything
Okay,
is
fine.
fine. So
Okay.
if we keep by 8:30 to 10:30, that is also fine. Then
Okay.
10:30 to 12 is also fine. 12:30.
Okay, fine. Okay. Okay. Okay, then next one. See, all these are very nice, good reading, okay?
Yeah.
And self-explanatory only. See, these formulas are all okay.
Mm.
These are all again one line answer only. Just go through this.
Okay, sir.
Hmm. This is done. This is okay, right? You are able to
Yeah, yeah,
understand, no?
yeah.
Okay. These all are very easy one, okay? Now price to book ratio. Yeah. So again, very, very nice one. When to use. You can quickly go through this one. These all are self-reading only, more like self-reading.
Yeah.
Hmm. Again, very easy one. See, calculating price to book ratio. So price to book ratio, book value of equity 2023. So I'll do only one, very easy only. I'll do one company. You can take the second company as the homework. See, book value, sales, outstanding shares, price. So the question is, what is price to book value? So book value per share we have to calculate. So book value per share.
Hmm. So, okay.
Book value
So
per
book
share
value
is,
per share, book value upon number of shares outstanding.
yeah, 7001.
Hmm.
Calculate this one, and the price
4. No, not this, not this. Yeah, book value is 4. Okay.
let's calculate.
4.45.
Hmm.
I'll do the second one also. It will take 2 minutes.
Okay, do it then.
How to find out the book value of equity shares? Like if they have not given the book value.
Book
So the
value.
equity shares on
Then
the
then
balance
then
sheet,
another way is
on
total
the
assets
balance sheet,
minus
na?
outside liabilities.
Okay.
Assets minus outside liabilities. This part.
Outside liabilities means creditors and all.
Yes. So equity except equity plus reserves.
Hmm. Shareholders' equities. Okay. And debt, long-term borrowing, that is
No,
also
long-term
outside.
borrowing is an outsider, no? Outsider.
Okay.
They are outsider. Insider is only the equity holder and reserves.
Okay.
Except equities and reserves, rest all you have to deduct.
Okay. Yeah, I got it.
Hmm.
Wait a minute, sir. I'll write down that book values for me.
Hmm, hmm, hmm.
Yes, sir. Done.
Same way only, price to sales. See, this is price is already given, price per share.
Hmm.
Price to sales means sales per share you have to find out. So
Hmm.
18878 divided by 7001.
Hmm.
You will get sales per share. That number you
Divide
have
by
to
the
divide
price.
17.83 divided by that number.
Yeah.
Just try.
It's easy, sir. Like,
Yeah, it's all one line
yeah.
answer only. Should I move ahead then?
Yeah, yeah.
But again, these theories are very interesting one, okay? So
Yeah.
please read it. Dividend yield. All these again one line only. Just quickly you read the question.
Yeah.
Dividend yield, what is the formula?
Dividend yield is MPS upon DPS or DPS upon MPS.
That is dividend per share.
MPS, this not, sorry, dividend per share upon market value.
Dividend, yeah, annual dividend. Okay,
Yeah.
annual dividend amount divided by the market value.
Hmm.
Okay. So here they said uh, next 4 quarters, these are the dividends. So
Hmm.
you have to add all this.
Okay.
Okay. Uh, now, yeah, these are the next 4 quarters.
Hmm.
and based on this 4.8. Trailing dividend yield. Trailing is just paid for 0.5, so which they have multiplied by 4, because assuming that is the same amount.
Same amount for the whole year.
Yeah. But this one is what they are expecting.
Done. What is underlying earnings?
Underlying earnings means earning which are supposed to you are supposed to earn. See, persistent or continuing earnings. Sometimes you might be earning more because of
Okay,
non-operating income.
non-operating income. Okay.
Okay, now like here, see, like here, gain on asset sale is a non-operating one. Extraordinary expense is a non-operating one. So for this entire year, if I want to calculate normal means underlying earnings or normal earnings. How will I calculate? These are
So,
diluted EPS stock price. These are diluted one. See, all these they have added 5.5. But from this 5.5, you minus asset gain. You are not going to get this 0.0 again. You are not going to incur this 0.5 again. So that adjustments has been done. And based on that, trailing PE ratio.
why have they added 0.55? Acha, that's
Because it is an
expense.
expense.
Expense, yeah.
So in future you will get more income.
Yeah.
This expense will not be continuing.
Yeah.
You can read this one. The counter cyclical tendency to have high PE due to lower EPS at the bottom of the cycle, and low PE due to high EPS at the top of the cycle is known as Molodowski effect. Okay.
Okay.
This is also quickly go through this now.
Yeah.
Under the method of historical average earning per share, the normalized EPS is average EPS over some recent period, usually the recent business cycle or recently 1 year you can take. Okay. That is earning per share average or historical average. Under the method of average return on equity. So this is based on book value. Normalized EPS is the estimated average return on equity multiplied by the book value per share. These are different ways to calculate the earnings. Okay, so the method of historical average EPS ignores size effects. So the method of average return on equity is preferred. Okay. Using the data in the following figure, calculate normalized earnings using the method of historical average EPS and the method of average return on equity. Magnolia Enterprises. Data for Magnolia Enterprises, amounts in Canadian dollars. Data for Magnolia Enterprises, amounts in Canadian dollars. Okay. So EPS, book value per share, and return on equity.
Okay. I'll just calculate.
Huh.
Sir, here why are they not taking average book value per share? So
Average
they
book
have
value.
taken the latest book value per share. Why not the average?
Okay, let me see. Using the data in the following figure, calculate the normalized earning using the method of historical average EPS and the method of average return on equity. So year 4.20. Okay, this EPS, book value per share, return on equity. Normalized earnings using average EPS per share. So 1, 2, 3, 4. So average return on equity. So okay, why have they taken 32.29, the last
Yeah.
one?
Yeah. Why not the average of all book value per share? Because we are taking average of EPS, we are taking average of ROE.
See, EPS is the performance.
Huh.
Okay, returns is the performance.
Hmm.
So performance is not going to be constant.
Yeah.
So we are taking the average one.
Hmm.
Book value, we have this much money only this year, 32.29.
Huh.
So from that amount only you have to get the returns.
Yeah.
Okay, so your returns are variable component, but your capital is not variable.
Hmm.
You have 500 rupees. Okay,
Hmm.
so you have the ability on an average to earn 20%.
Hmm.
So I will take 20% of 500 rupees. Now what do you have? Now you have 500 rupees.
Hmm.
So that's why current. So this is, see, they have mentioned 2023. So normalized earnings for 2023. You can see here.
Hmm.
Understood?
Got it. The capital cannot be increased
Yeah,
basically.
yeah.
Got it.
Explain and justify the use of earnings. Earning yield. Earning yield is the opposite of uh,
P.
dividend yield. So dividend yield is the annual dividend divided by price of the stock.
Hmm.
Then earning yield is, earning yield means, earning yield is the opposite. One second. Earning, sorry, not this one.
It's the
Not this
opposite
one.
of P
Earning,
ratio, na?
opposite of, it is the opposite of P ratio. Yeah. Okay. Not dividend yield, it is the opposite of P ratio.
Yeah.
So price by earnings. Okay. Price by earnings. And dividend yield, earning yield is,
Earning by price.
yeah. So basically, this is called earning yield.
Hmm.
So what it means is okay. Earning yield means for 1 rupee how much you are able to earn. Okay, here to earn P ratio means to earn 1 rupee how much you are willing to pay, and here to earn 1 rupee, I mean to from 1 rupee how much you are able to earn. That is earning yield. Okay.
Okay.
A high EP suggests a cheap security,
Okay.
right? Because with 1 rupee in one share I'm able to earn 3, in another share I'm able to earn 2 rupees. That means this is better for me.
Yeah.
This is cheaper one.
Yeah.
Okay. These are all very nice, all good information. Then justified P multiple. This we have already done, right? Yeah, we have already
Yeah.
done this one.
We have done this.
This one. Okay. These are all one line only. These all you should be able to do now. Let's go through this.
Yeah, I'll just do it, sir. Done, sir.
This one you want to do?
Yeah,
Or you
yeah,
want
I've done that. I did that.
did this also?
Yeah.
Yeah, justified price to book multiple. Okay. See here, I need to prove this formula to you.
Okay.
Okay. So growth is equal to return on equity into retention ratio, that we already know. Earning is equal to initial book value into return on equity. Is that okay? Now, price to book is equal to return on equity minus growth divided by R minus G. Okay, so this is price to book value. So how do we justify this? See, P0 is equal to D1 by R minus G. Again, I'm using Gordon growth only as the base. Okay, then now this D1 I can write as B0 into return on equity into 1 minus B divided by R minus G. what does this mean now? This is the return into 1 minus retention ratio. B indicates retention. So this is the return, total return minus 1 minus retention will give me dividend payout. This step is okay. Right, B0 into, that means total returns. This is the earnings. Okay, it is mentioned here also. The earning, B0 into return on equity is the earnings. So earnings into 1 minus retention will give you dividend payout ratio. Okay, then now I'm dividing by B0 both the sides. B0 by B0. By B0, and here also R minus G. So I'm dividing B0 by both the sides. So now this gets cancelled. Okay. So now next step is so ROE into 1 minus B divided by R minus G. Okay. So now growth, see, I can say growth is equal to ROE into retention ratio. So retention ratio is equal to, I can say, growth by ROE.
Growth is equal to ROE into
So
retention
retention ratio is equal to growth by ROE.
Okay, okay.
So growth is equal to return. I mean RR retention ratio is equal to growth by ROE. Okay. So growth retention ratio is denoted as B. Okay. So B is equal to G by ROE. So I can say ROE into 1 minus G by ROE.
Okay.
So ROE, here it will be ROE into ROE minus
G.
growth
Yeah.
divided by R minus G.
Yeah.
Now this gets cancelled. So now that's it.
Yeah.
ROE minus G. This is the derivation. It's a little tricky. Though you don't require the derivation, but then it will just help you to understand the logic behind it. This is the formula that you have to remember. Okay. Otherwise, it is just applying. Once you know the formula, it is nothing, just applying it. Okay. Direct formula only. The sum is okay.
Yeah. Yeah.
Price to sales. So price to sales is also same, similar kind of logic. See, P0, again everything starts from Gordon growth model only. Okay. Now this dividend I can write as in this way, price to sales. No? So dividend is so D0 into 1 plus G, first of all. Okay. Then now D0, this I can write as earnings into so earning, which is what, E0 by S0. This is my earnings, not S0, earnings. Earnings into 1 minus retention ratio. Is the dividend payout ratio
Hmm.
into 1 plus G.
Hmm.
This step is okay.
Hmm.
Now I will divide by S both the sides. Hmm. This is the formula.
Hmm.
R minus G E. So I'll just bring this E towards this end. E0 by S0, 1 minus B, 1 plus G. Okay.
Yeah. Wait, I'll just write that down.
Hmm. If you practice like this, you don't have to remember half of the formula only.
Hmm.
Then.
That justified price to book also I've written. I've uh, that like that ROE I've done through. I've broken the ROE formula and then I've written it like that.
Mm-hmm. Yeah.
So uh, 1 by growth upon this
Hmm.
retention ratio is equals to ROE. So I've written it like that.
Mm-hmm.
So I've written it in all basic forms. So if I know the basic forms, so I can just convert it into whatever formula I need.
Mm-hmm. Hmm.
Yeah, done.
Now this formula can be rewritten as this is net profit margin
Yeah.
into justified. This part
Hmm.
is
Justified.
justified
Yeah.
leading trailing P ratio.
Hmm.
Justified
Hmm.
Hmm. Sums are easy, just you have to
Yeah.
plug in the number. Just try.
Yeah. I'll do that.
Hmm.
Done, sir.
Price to cash flow. Okay. So this is, yeah, now instead of dividends, I'm using free cash flow to the firm. Same logic. Okay. You can write all these formulas, somewhere.
Yeah, I'm
Like
writing it down.
Yeah. No, even otherwise in your whiteboard rolling paper, and then hang it so that all formulas are there in front of your eyes. So justified price to cash flow model. Price to cash flow is based on cash flows. So price to cash flow. Then EV to EBITDA. Then justified dividend yield. So justified dividend yield also, see, this looks like a new formula, but it is not. See, I'll just prove that. D0 is equal to, not D0, P0 is equal to D1 by R minus G. So D0 into 1 plus G. Right? Shift this D down. So P0 by D0 is equal to 1 plus G by R minus G. That's it. Now you invert it. D0 by P0 is equal to R minus G by 1 plus G. That's it.
Yeah.
See, again, you don't have to remember this.
Yeah.
Justified
Only the
dividend yield.
Gordon growth model you have to remember,
Yeah.
then we can do anything with that.
Yeah.
Yeah, then sir, written that.
Then cross-sectional regression refers to regression in which the explained means y variable and the explanatory means x variable are all based on the same point in time. That means in 1 year how x was moving and how on that basis how the variable y was moving. So this is based on linear regression basically. Predicted P ratio. Predicted means again using linear regressions. Linear regressions. Linear regressions. And it will have its limitations as well. Okay. Multicollinearity, all these things you will learn in quantitative methods. Okay. This has been highly elaborated in quantitative methods. So right now that line you can ignore. See, this is the equation. They have directly given the equation. You just have to plug in the number. So how did we get this? All through, remember, level 1 linear regression model. So we get intercept and then beta this way, and these are all the variables. Dividend payout is the variable, growth is the variable, beta is the variable.
Okay. In the question itself, they have given us the equation. We just have to plug in dividend payout, growth, and beta. Yeah, we can move forward.
Okay. Evaluating P ratios with the method of comparables. Albright P, trailing leading growth beta. Instead of comparables. Again, just theory. Just read this one.
Yeah. Yeah, that's
See, all these are easy only. See, all these theoretical kind of questions only. You can do on your own also.
yeah.
This part all. Shall I move ahead, or you want
Yeah,
to
yeah.
quickly read now
No.
and then see?
Okay, if I'll read it 2 minutes. I'll read it.
Okay, fine, read.
Done, sir.
Hmm. Ha. The Fed and Yardeni models. This I have to explain. Okay, so it says the Fed model considers the overall market to be overvalued when the earnings yield on the S&P 500 index is lower than the yield on US 10-year Treasury bonds. So that means, see, it is as good as if 10-year Treasury bond is giving you, let's say, 5 percentage. 10-year Treasury bond yield is giving you 5 percentage. No, not 5, 5%. Okay, 5 percentage. And if you are earning 4 percentage from the stock market, then the stock market is overvalued. Understood this one? Market is because you are earning less. Why are you earning less? Because the market is overvalued.
Okay. We are earning less.
Market is overvalued when
Ha
the
ha ha
earning
ha.
yield. Earning
Ha.
yield means what? For 1 rupee that you are investing,
Hmm.
your yield is lower than your yield on the S&P 500 is lower than 10-year US bond.
Hmm. Hmm. Got it.
The Yardeni model includes expected earnings growth rate in the analysis. So here CEY stands for current earning yield. So current earning yield CEY is equal to CBY minus K into
LTGE.
LTEG plus error.
Sir, earning yield on S&P 500 means the returns, na?
Yeah.
But how can be
No,
the
returns means returns is not the
earning
profits.
yields
It is
mean the
about the
cash flows basically.
no. Earning yield is based on the price what you have invested. That means returns on your investments. Returns on investments, because earning yield is what earning divided by price, right? Based on the price what you have invested.
Hmm. So whatever
So,
price I have bought the stock on that, it's basically individual.
yeah,
This Fed model
individuals.
is
Yeah,
based on individuals. So
yeah.
if someone has invested on a lower price and has a higher earning yield, so it can be opposite.
Yes. But for that time period you have to calculate, right? In 1 year's
Yeah,
time.
yeah,
What was the price and what you are earning?
yeah.
1 minute. Okay. Now, current earnings, current Moody's A-rated corporate bond yield. So, corporate bond yield minus K is a constant assigned. So,
Means,
about 0.20, 20% weight given.
means.
So, 20%, I'll tell you, 20% weight. Long-term earning, ET is long-term earning growth plus error. Mhm. So, see, first we'll understand, we'll also write P ratio. P ratio is the inverse of all this.
Okay, through this model we can calculate earnings basically.
Yeah, current earning yield. See, current earning yield is um, current bond market yield. Okay, then uh, this is the long-term growth, earnings growth, and
Hmm.
long-term earning growth constant assigned by the market to earning growth. That means we are giving 20% weightage. So current earnings yield. So earning yield means for 1 rupee, what are you earning? You are earning bond yield minus 20 percentage of this growth.
Hmm.
Okay. If this one, if this is uh, okay. If overall, this earning, let's say expected earning growth in the analysis, ignoring the error term, this shows P is negatively. Okay. Well, let's understand this one only first. I think
Hmm.
after that it will be easier. See, P ratio means to earn 1 rupee. So this is my earnings. Okay, this is what I'm earning. Corporate bond yield. From that, minus 20 percentage. I'm 20 percentage of the growth. So long-term earning growth is, let's say long-term earning growth is 5 percentage. So 20 percentage of that earning growth. So corporate earning growth I'm reducing. So let see. Say for example, current bond yield is, let's say, 7 percentage minus 20 percentage of long-term earning growth rate is 5 percentage plus error, you leave it. Just calculate this, how much it comes to.
Yeah.
This will be 7 percentage minus 20 percentage of 5 percentage will be
1%.
1 percentage. So
6%.
6 percentage. So that is, so I'm earning 6 percentage. 6 means 0.06 for okay, to earn 0.06 I'm paying 1 rupee. Okay, to earn 0.06 I'm paying 1 rupee. Okay, so this is price price that I'm paying to earn this much money. So this is what, this is earnings. How much am I earning? So that earning is only, shown over here.
So
Current
I am
earning yield.
paying 1 rupee to earn 0.06.
Yeah,
So that's bad.
that's not bad. I'm if you convert it into percentage, then it becomes 6 percentage, right? So 6 percentage. Now you can compare them. Okay, whether you are earning more or less, then you should be able to compare with other products.
Okay, but I am paying more to earn less.
Yeah, but that is the case. You are paying 100 rupees in your fixed deposit to get 6 percentage only. Now 6 rupees only you are going to get.
Yeah.
In saving account, you are giving 100 rupees to get 3 percentage.
Uh,
In bond, you are giving 100 rupees to get what? 8 percentage or
8
so.
to 10%. Okay.
Okay. So this is what you are earning.
Hmm.
Okay.
Hmm.
Yeah. Now this earning, suppose this can be elaborated, this concept can be elaborated further. Current, but they have not given though, because see, current corporate bond yield, if this corporate bond yield is more than the, see, overall this current earning yield, current earning yield. So current earning yield is current earning yield. This is the price. If this earning is more, uh, if this earning is not even, if this earning is lower than the corporate bond, no, how can I, one second, how can I interpret this? Corporate bond yield is A-rated corporate bond yield. If this current earning yield, so this is what I'm earning. Okay, let me come back to you with one example. Okay, just give me some time. Next time I'll just explain this. Wait, I'll just note it down because I can elaborate this further. It is not given in the book.
We don't have sums on this, na?
Yeah, there is no sum, but I think conceptually I should elaborate a little more. Wait, I'll just note it down. Wait. I'll just mention. I'll just come up with a sum, and then we can compare whether it is overvalued, undervalued. So that sum is not clicking my mind now, but I will just come up with one. Okay.
Okay.
Yeah. Then PEG ratio,
Yeah.
that is price earnings to growth. So that
Growth.
means
Yeah.
for per unit of P ratio for per unit of growth is
Hmm.
interpreted as P per unit of expected growth.
Hmm.
Per unit of expected growth. Okay. So it is not percentage, okay, it is per unit. That
Yeah.
means if
It's
they
per
say
unit.
5%, then you have to take 5 only, not
Hmm.
percentage. See this one. Growth rate is 14.5 percentage. So here it
Hmm.
is 14.5 only.
Hmm.
It's a one line answer. Let's go through this.
So if peg is less than 0, then it's good, na?
See, less than 0, you are not going to get anywhere. It will be less than, 1. If it is less
Ah,
than
sorry,
1,
less
it
than
is,
1. It's good.
yeah. So less than 1 is very good, but again, very difficult to get. Okay. Less than, you can say less than 2 is
Hmm.
something that you can get, because if the growth is very high, the price will also be high.
Hmm.
Less than 1.5 is very good. Less than 1 is excellent, but you will not get it very easily. If you get it, it is very good.
But then we cannot just go on peg ratio, na? If I'm getting some company which is less than 1, then we
Mm,
just can't go on that, na?
huh.
How the peg ratio is less than 1? If the PE is very low or growth is very high.
Yes, then it will be less than 1. No?
Yeah.
Hmm.
I have got a few companies who have 0, less than or
No, but
1
that
peg.
will be penny stock. All that
Yeah,
plays a role, right?
but they have very less growth. Like the growth is not that much in the previous this quarters. I've noticed that.
The growth is not that much. Okay, then that means the P ratio is
Low.
low, and that's why it is looking very big. Then, if P
Hmm.
ratio, yeah, P ratio, and that's why it is looking very low. Then,
Hmm.
hmm.
And PE ratio is low means the price might be low or the earnings might be high.
Hmm. Yeah,
Okay.
just go through this somehow.
Yeah, I've done that some set.
Okay, this is also we have done. This is EPS, expected EPS. This is just what I told, that price is equal to PE into earning. If it is expected E1.
Hmm.
No, this is same.
So what is terminal value? Can you explain again?
See, terminal value means if I want to calculate
Hmm.
what will be the price after 3 years.
Hmm.
So I have to calculate this is price for 3 years.
Hmm.
So this is my terminal value then.
So
Okay.
my price in the future is the terminal value
Terminal
basically,
value. Yeah, yeah.
or any thing. My cash flow in the future can also be my terminal cash flow.
Whichever year that I'm looking for. When it comes to
Anything in future.
equities, when it comes to equities,
Hmm.
from where stable growth is beginning, that is terminal value.
Okay.
Now from here stable growth is beginning. So this is terminal value.
Okay. So from the point through from where we can apply Gordon growth.
Yeah.
Hmm.
You want to try this
Yeah,
one?
I'll try that. that an analyst estimates Polar technology in 5 years, EPS of 5 years to be 2.1. Then again, the 6th year EPS would be 2.32. So which EPS should we take? So they are
Wait,
saying that
an
in
analyst estimates the EPS in 5 years is to be 2.10. The EPS in 6 year it is 2.32.
5.32.
The median trailing. Okay, yeah, median. You should see EPS will keep changing, right? That's why we will go for average or median one. See,
Okay.
even in screener you have, right? See this one.
Trailing 12 months.
See, median P is there. If I take any company, TCS.
I cannot see the screen.
Now you see this is TCS. And this is P ratio.
Yeah.
Now P ratio can change from time to time. Then what P will I believe in? That's why median P.
32.1.
31.2.
Yeah.
But current P is what? Current P is 22. 22, 23 it is there. Okay. So it has the ability to go to that extent. But it is highly undervalued. It's highly undervalued. So if I see,
But just on the basis of P, we cannot tell na कि it's undervalued or overvalued.
we have to reconfirm with other parameters also.
Yeah.
But it is on the surface.
Yeah.
That can be the reason for further research.
Yeah.
Because EPS is increasing here. That is a good sign. EPS is increasing and P ratio is coming down. Okay. One reason is the expectations, like that it is losing business because of AI and all those things. That is pushing the stock price down. But but the number is not saying that. The number says EPS is going up only every year or every quarter. It is going up only. So it warrants for further like investigation and probably a good pick.
Their ROE, ROCE is also very good. 52% of ROE.
Yeah. So this AI and all those things, I think for companies and all, it is going to be good only. For employees, these are bad. For companies, it's clear that EPS is going up.
Okay.
Cash flow is equal to a formula. This is net income plus depreciation plus amortization. Cash flow. One common used proxy for cash flow is earning plus non-cash. Again, this proxies and all, I don't think will be asked. Okay. This is what we have already done. This kind of formulas we have already done.
Yeah.
So again, these are all 1 line, 2 line answer only. Let's try this.
Yeah. Done, sir. But sir, in this, we have to find the cash flow or the free cash flow. Because everything that they have given indicates free cash flow.
No, both are same only. After deducting all expenses, only what is there, that is only cash
But they
flow.
have not added they have not added the interest expense in this.
Yeah. No, that is an indirect method, no? Indirect one. Okay,
Okay.
1 minute. 1 minute. Net cash. Because it is not, that is not free. This is not free cash flow to the
Huh.
firm
Huh.
to add interest. It
Okay.
is, that is there with the company. That means it is more like equities.
Okay.
Then enterprise value. So this enterprise value, this is the formula.
Yeah.
This is when you are acquiring a company.
Huh.
So EV is equal. So EV multiple is equal to enterprise value divided by EBITDA.
Yeah.
And EV is equal to market value of equity, market value of debt,
Hmm.
market value of preference shares, minus, or minority interest also will come, plus minority interest.
What is minority interest?
Right now you take it as minority interest only.
Okay.
What is minority interest? You will learn in FSA. Minority interest means basically when you are acquiring a company.
Huh.
Okay, when you have acquired a company, imagine 80% you have acquired.
Huh.
So you are taking all the assets and showing in your balance sheet because you are only the owner now.
Hmm.
But then 20% does not belong to you.
Yeah.
So that 20% you will show in the liability as minority interest. Okay.
Okay.
So out of all the assets that you have taken, 20% does not belong to you, no?
Yeah.
So you will show in liability as minority interest. Right now you
Okay.
just simply take it as minority interest.
Hmm. Minus cash, no?
Huh. Minus cash and marketable securities. Okay.
Hmm. I'll do this some sir.
It's very,
Yeah.
just you have to stick to the formula, nothing
Yeah.
else.
I'll do that. Sir.
See, market value of debt is given, cash.
Hmm.
Then, yeah, this is market value of equity.
Hmm.
Hmm. And then, yeah, this can, you can use it to calculate EBITDA.
Hmm.
This is to calculate EBITDA. So EBITDA,
So we have to add that na in net income,
EBITDA
both of
minus
these
depreciation, EBIT minus
minus
interest,
interest.
divide, then EBIT, EBT minus tax.
Yeah.
Okay, earning after tax. So net income is, they said 13.75.
Hmm.
So if net income is 13.75,
So we will add 95.9 as tax.
tax is 90. Yeah, correct.
So we will
95.9.
get EBT.
So you will get EBT. Then
Yeah.
you add interest. Interest is 6.9.
Yeah.
So you will get EBIT.
Yeah.
And then you add depreciation. Depreciation is 10.4. You add depreciation, you will get EBITDA. That's it.
Yeah.
Do now.
Yeah. Sir, why have they reduced investments like investments?
Why have they reduced investments?
Yeah, they have reduced from EV. They have reduced investments in EV.
Investments
In the answer
327.
there.
Yeah. Minus
So if
62.3.
you are acquiring a
Cash and
company,
marketable securities and investments as well. Yeah.
but when we the investments that they have made, that also adds value to the.
Yeah, that's why we are reducing. See, the logic why we are reducing this one is
Huh,
when you buy the company, you have paid money for all this. Now, whatever is there within the company, that is yours. That means that cash belongs to you. So your expenses are coming down. No? Now, whatever you have paid. So let's say, for example, you have paid overall the market value is 1,000 rupees. Now
huh.
there is cash of 100 rupees. So that means your expense is coming down now. Now it is as good as you have paid only 900. Then you got to know that there is an investment of 200 rupees. That is
Hmm.
also yours only now. So that means you have paid only as good as 700 only now.
Okay. But my logic
Hmm.
in this, my logic is that we are evaluating the value of that enterprise.
Hmm.
So if that enterprise owns that investment, the value of the enterprise goes up.
That is already reflected in the market value of equity.
Okay, okay. So you're not paying it twice. Okay, got it.
Yeah.
Yes, sir, done, sir.
An alternative measure of a company's overall value is the total invested capital, sometimes referred to as market value of invested capital. Total invested capital is the market value of invested market value of the company's equities and debt. Unlike enterprise value,
Hmm.
TIC includes cash and short-term investments.
Hmm.
TIC total invested. Unlike enterprise value, TIC total invested capital. Uh, okay, it includes short-term investments. Okay, fine. So in addition, EV to EBITDA and TIC to EBITDA, analysts employ enterprise value with EBIT also, free cash flow too. These are all other ways also. So not necessarily that everybody has to follow EV to EBITDA. Okay, so EV to sales also they can follow if the company is making losses.
Hmm.
So EV to EBITDA sales, price to sales, because these are all for loss-making companies.
Hmm.
Okay.
But if the company is making losses, then why are we evaluating it? Like
Because we believe that
that
acquiring that
company in
company will
future
bring
will
in
be
synergy. It will bring synergy.
okay.
Synergy. So for me, it will be easy for me to get raw materials
Hmm.
from that company or distribution
Hmm.
network.
I'll
Like
get into.
Reliance, let's say
Uh,
Reliance bid
huh.
for that big bazaar. Why so? They will get free distribution, right? Ready-made all
Hmm.
buildings.
Hmm.
Okay, that is the reason. So that's why any loss-making company also will be acquired by another company, right? A
Hmm.
loss-making bank. Now, free, this branches
Hmm.
they will get
Hmm.
free as in ready-made branches, ready-made employees, all.
Hmm.
So that is also possible. Or whether the capital structure is very different, then EV to sales. Okay.
Yeah.
Earning surprise
Sir, what
reported
were
earning.
those momentum indicators?
Uh, Momentum indicators relate either the market price of a fundamental such as EPS, to the time series of historical or expected value. Common momentum indicators include earnings surprises.
So
So
these are
momentum,
anomalies basically.
yeah. Standardized unexpected earnings
Ah,
and relative strength.
ah.
These are anomalies or momentum, which is deviating from the normal one, showing
Got it.
momentum. So that is unexpected earnings. This one.
Hmm.
Standardized unexpected earnings. Earnings surprised by standard deviation of earnings surprise. Hmm. In this formula, are you able to understand standardized earnings
Yeah.
and unexpected earnings surprise divided by standard deviation of
Hmm.
earnings?
Hmm.
Okay. Harmonic mean you already know, right?
Yeah.
Harmonic mean
Yeah.
is arithmetic mean. There is an example here. Okay, there is an example here. Arithmetic mean and weighted harmonic mean. Okay, we have to do this example. Okay, just read this then. The price to earning multiple for a stock index is not equal to the mean or weighted mean of the P of the portfolio index. Okay, the price to earning multiple. So consider two stocks, one priced at 10 with earnings uh, uh, consider two stocks, one priced at 10 with earnings of $1 per share.
Hmm.
Okay, so 1 P ratio is 10. Okay, and one priced at 16 with earnings of 2. So earning, no, this is 10
Price means
and one
this
priced at
na.
16. No, one priced at 10. Okay, okay.
So means the market price is
Earning per
at,
share is
yeah,
also 10. Earning per share is 1.
one.
And here earning, this is P ratio is 16.
P ratio is 8, sir, in that. The price means the market price, current trading price.
Wait. Consider two stocks, one priced at 10. So P is equal to 10. And earning is 1. Is equal to 1. So therefore, price to earning is equal to
10.
10. Then another one priced at 16.
Hmm.
And earning is 2.
2,
So price to earning is equal to
8.
16 by 2, 8. For a portfolio with one share of each stock, okay, earning per share is 1 plus 2. Yeah. So one share of each stock. So you will get 3. And the price of the portfolio will be 26. So P ratio. So combined will be, price will be 10 plus 16. Combined earnings will be 1 plus 2. So 26 by 3. So that is equal to 8.67.
Hmm.
So this is 8.67. We will demonstrate that the portfolio or index PE is best calculated as weighted harmonic mean. Okay, so now 8 and 10. Harmonic PE is where is this 8 and 10 coming from now?
8 and 10 are PE.
This is 8 and this is 10.
Yeah.
Okay. So arithmetic PE is arithmetic P is equal to this two, 8 plus 10 divided by 2, that is equal to
9.
9. Then weighted mean and harmonic mean and weighted harmonic mean. Okay, so weighted mean. So weighted mean is 10 and 20, 10 and 16.
10 and 26, no? Like
Weighted
out of
mean is 10 and
26,
8. So there is 10 and there is 8. And for this 10, the weight is, its weight is 26. It's like weighted mean. So the weight is 10. So 10 out of 26 into 10 plus 8 out of 26. Is it 26? I'm not doing it properly. This is the portfolio price to earning. Now weighted mean. Weighted mean.
so 10.
So mean is, first of all, weighted mean. Weighted mean is from the first one, 10 rupees, if I see, weighted mean of what? P, weighted mean of P. So my first P is 10. So from this 10, I'm going to give weight. So the weight is, its weight is 10 by 26. Why 10 by 26? Because
the total price of the
its price
portfolio is
is 10.
26.
10 out of 26. So 10 by 26. Then plus the second one is 8. 8's weight is
16.
16 by 26. Ten by 26. 16 by 26. Okay, just calculate this.
Yeah. $8.76. Hello. 8.76.
Yeah. Okay. Yeah. So this is done. Then harmonic mean. Harmonic mean is equal to n divided by 1 by x1 plus 1 by x2. This is the formula. Okay, so n is 2
26 na x n is 2. Okay,
divided by 1 is
10
and 1 is 8. The p ratio 10 and 1 by 8. So solving this, solve this, all
Yeah.
we're getting 8.8.
No.
Overall 8.8 you should get.
Yeah, 8.8. 8.88.
Yeah. Then weighted harmonic mean. So weighted harmonic mean means now 1 by
Same
10, but you will give weight
here.
of what? 10 by
10
26.
out of 26.
1 by 8 here.
16 out of 26.
Calculate now.
Sir, I'm not getting the right answer here. Hello. You're on mute, sir.
Oh, sorry. Yeah, I'm not getting the right answer.
I'm
Why?
getting the denominator I'm getting is
10 by.
0.5.
Hmm.
So 1 divided by
What is this coming to?
1 divided by 10 is 0.1, store
Hmm.
1, and then 10 divided by 26 is
Hmm.
10 divided by 26 is 0.3846,
Hmm.
store 2. So recall 1 into recall 2, 0.03846.
Hmm. Hmm.
Okay, and then 1 divided by 8 is 1.1, 0.125,
Hmm.
store 1. 16 divided by 26 is this 0.6153 into recall 1. 0.07692.
Hmm.
So 0.3846 plus 0.07692. 0.4651. Okay, so 2 divided by recall 1. 4.33. I'm
4
not
point.
getting it. I'm not getting it.
Okay, I'll do. 1 by 8 into 10 by 26. Okay, so 1 by 8.
10 by 26. 1 by 10 into 10 by 26.
So
1
1
by
by
10.
10 into 10 by 26. So 1, I'll make it like 8 decimals. Second format, 8, enter. 8 decimal. Now 1 by 10 into 10 by 26. So 1 divided by 10. So this is store 1. Then 10 divided by 26. So store 2. Okay. Then so recall 1 into recall 2. So this I'll keep it as something like store 8 separately. Okay. Then 1 by 8 into 16 by 26. 1 by 8. This is store 1. Then 16 by 26. 16 by 26. This is store 2. So now recall 1 into recall 2. This I'll keep it as store 9. Okay, now add these two. So recall 8 plus recall 9. So 11.538.
Yeah.
2 by 0.11. And this I can inverse it. Inverse multiply by 2. Inverse
I'm getting
multiply
around
by
17 point something something.
17.33.
Answer is 8.67. Okay, we have done it. We have divided it by this 2. We have to do it by 1.
Weighted harmonic. Oh, okay. Acha. Weighted harmonic divided. Okay, because we are giving weight over here. Okay, okay, okay. So it becomes one. Acha, that is this I didn't notice. Okay.
Got it. That's why we are not getting it.
Okay. Okay, fine. This is one point. Okay. Okay, then next one. See, all these model quizzes are easy only. Okay.
Yeah.
Okay, residual income valuation. Okay, this then we can begin from next time. Okay, so you just practice all this till here, and then please finish the model quiz also.
Yeah.
Here you will get to learn something more, beyond whatever we have done in level 1.
So this is new.
Little
Completely
new, but again not very difficult as such. It is just the extension of the logic further. Okay,
Okay.
but not like very difficult, nothing like that.
Hmm.
Okay, so there's another way to value a company. So we have seen
Okay.
dividend discount model, free cash flow. What if there is no dividend? Company is not paying dividend. Then we will
Ah.
go for free cash flow. But what if there is no free cash flow? Then what to do? Then there is residual income. This is another way.
Hmm.
Okay,
Okay.
fine.
Okay.
Okay, we'll stop now. Yeah, this we'll see next time. Okay.
Okay, sir.
Okay then. Bye.
Bye,
Bye.
sir.